as we were discussing the money, the topic we started last week, we will continue to have the discussion, and as I was requesting all throughout, you can actually raise any questions that you wanted to raise directly through the arrangements in terms of communicating here, either through the chat box, or for that matter, you can also communicate in terms of unmuting and raising any concerns that you have. And effectively, we have covered to some extent what we were discussing in our last lecture, which is very much in line with functions of money. And of course, we talked about the meaning of money from a broader perspective. And then, of course, we have to very much maintain the fact that it is not only accepted in payments for goods or services, but also in the repayment of past obligations. That is very important, because most of the time what I have seen in terms of explanation, even to kind of understand the meaning of money, when somebody query, most of the time people come out with the general explanation that acceptance for payments of goods and services. That's right, it's not wrong. But more meaningfully, it also have to include your repayment of previous obligations. So why today's world is functioning in a certain parameters, this element is very important, and this has been noted at many points. And please remember not to forget that element when you are describing. So we looked at the functions from a broader perspective in terms of a medium of exchange, unit of account, and store of value. So these are not necessarily new to most of you all. You all have heard that, at least in your previous efforts in understanding some of these subjects. But at the same time, again, we repeated for the purpose of this program with more insights into what you might come across in our future discussions. Okay, so interestingly, this money has evolved over the period of time, mainly in the form of a commodity money to a fiat, that is paper. Okay, so commodities, you already know, these are mostly the either valuable form of commodities, if not easily standardized and divisible commodities. And even, you know, we were discussing some of these examples, including cigarettes, right? So mainly the precious metals, and then of course at different times of these evolutions, there are other forms also being accepted as a general payment for goods and services and repayment of debts. So you see the commodity money from a broader perspective, but interestingly, in today's financial markets and today's modern financial system, basically looked at fiat money. Fiat money is paper money decreed by governments as legal tender, and that's been standardized, that's been divisible, that's been in the form of values that matches with that economy's requirements. Because sometimes you find why in Sri Lanka the biggest note is 5,000, whereas in some countries it is 5 millions, 10 millions. That depends on the economy's requirements, right? So you see, I mean, this paper money has evolved to address most of these concerns, and has been still evolving. And there is no concrete conclusion that we will see fiat money or the existing money form would end tomorrow and beyond that we will not have the fiat money. No, it would continue to have it, but it will also evolve to the extent the forms of this money would match with the requirements of evolving economic circumstances. So keep that the evolution option more or less accepted to say that it would further evolve. And similarly, you probably recognize these payment system evolutions, right? So checks are nothing but instructions. You see, you give instructions to your financial intermediary to move your account balances, right? So it is basically an instruction. Today you probably see checks comes in the form of papers being signed and exchanged, but at the same time the instructions could come in many forms. Today sometimes virtual wallets that we are talking, so you might not necessarily require checks to be kind of signed and exchanged, right? So for that matter, you might basically use your electronic instructions through various accepted forms of communication with security features, right? So that security features is a very important element in this evolution of payment system in recent times. And these electronic payments are almost of a necessity in today's context. And of course, the importance of these electronic payment systems and other electronic payment structures become so important in today's context with the existing pandemic circumstances too. And everybody would agree a further evolution is in the pipeline, because everybody is devising new mechanisms to see how safe and secure the electronic arrangements and further enhancing the safety features of these arrangements. And then you see all these e-money that is in use, debit card, stored value cards. That's what you mostly see in terms of all these payment cards for transportation, then services, prepaid cards. Those are stored values, right? So these are available and reasonably not that common in Sri Lanka's case, except for the fact that prepaid mobile kind of payment structures. But in other countries, for everything you have prepaid card, even to kind of, you know, use a transportation, use a taxi, to get you groceries from a certain grocery chain. It's all there. So it's very common in those countries. But Ceylon, I mean, the Sri Lanka also accepting these and now evolving to great extent. So you see these evolutions, and to the extent that people could ask the question, right? Are we headed for a cashless society? With all these things that you are seeing, what do you think? I mean, it's open question for you all. You also can see whether we are in that direction in terms of building a cashless environment for us. It's all open, right? So it's one could can be seen across this, and this load of developments that you are seeing in the financial markets and the financial systems are evolving, and there's a query in terms of whether this handout is uploaded. It was this is the same thing we used last week also, and I believe it's in the system, and we also have a new handout for today's discussion is already uploaded. That is on a very, very timely and interesting and important topic on interest rates. So what I'm talking here is the money. So we are seeing here this element. Are we going for a cashless environment? So that is one of the very timely and pertinent questions. Okay. Interestingly, this prediction of cashless societies, it's not only a kind of, you know, something that people started discussing today. It was there for a certain time now. I mean, for decades. But this has not come to a reality, because with all these developments that we are seeing in terms of payment structures, still societies are favoring cash, right? Societies are favoring cash. Societies are looking at these in terms of a way of handling your payment arrangements. Okay, there are things that these payment structures accept in today's context, and they are facilitating these to great extent in their arrangements. So what we are basically seeing here is these payment arrangements that you are familiar with would be definitely helping societies to look at the ways through which that facilitate their payment requirement. So we are not necessarily seeing this cashless discussion has come to a reality. It's still continuing, and it's evolved again in terms of changes that you are seeing electronic payment structures. Yes, you agree that e-money or whatever that we were talking just now becoming more and more convenient in today's context, and also efficient than payment system based on paper. But still, several factors work against the disappearance of a paper system. There are a number of factors that still make keeping a paperless environment far from a reality. And one aspect that you could argue in support of this is, yes, e-money and its usage is enhancing. It's increasing day by day. People are now taking electronic payment structures more favorably than how they were looking at those in the past. And the younger generation is more into electronic payment arrangements than paper-based payment arrangements. So these are the developments through which that we are now seeing where the argument for cashless societies are heading. But still, paper also part of the financial system, and still kind of holds the biggest, if not the bigger share of financial transaction in the markets. And that's to be a very important element that you will discuss all throughout. And you see a current financial discourse talk about at one point you will see the societies would favor cashless, paperless, but electronic payment structures. The concept arose from all these global developments of digital financial services and the development of technologies. Okay, and potential application for financial markets, because cross-border transactions, timely exchange of finances from one location to the other, all being enabled by electronic, if not digital financial services now in place. However, the claim about the impending obsolescence of paper money is very much of a something still to realize. Instead, the conversion of money from paper to bits has been a gradual, adaptive, if not continue to have parallelly with papers, although we see digital arrangements still facilitate, because you don't see today most of your payments in terms of salaries and wages do not come to your hand in the form of papers, but mostly it's credited to your accounts, and your payments to majority of your other payment arrangements, even utility bills, goes out as instructions to your accounts. And these are more or less like driving to the digital form of financial services in favor of paper form of financial services that we used to in the past. Okay. Moreover, the certain statutes in the form of legislations required to popularize this e-money still to evolve, yes, it's there in place, but there are a number of other areas also to be looked at. And also the monetary authorities like central banks also taking very serious look at these developments. And beyond this, there are other form of financial arrangements also now in application. We'll come to that point towards the end of this discussion today. And therefore, you can argue for and against when it comes to a cashless, paperless financial transaction environment. But what is interesting here is more and more people would move into electronic form of transactions, electronic form of payment structures, while still continuing to have some form of paper-based structures in the economies. And you cannot simply take out the paper-based structures from existence. It is much more requirements in terms of other financial markets and other societal, social, and economic considerations that different countries have. But interestingly, the importance of electronic payment structures have become very significant in recent times, and evolving at a much faster pace than how it was about a decade, or even for that matter prior to 2000, let's say 15 or 17. So you can see since the recent pandemic-based developments, the expansion is much faster in terms of acceptance for electronic payments. And we are moving to measuring money. We will see this as a very important step in our directions to see how money supply being looked at going forward. But before I move into this, any questions?
Sir, this tute isn't uploaded.
Right. I probably check again with IBSL. Give me a second, because this is not good. I mean,
Okay, sir.
they have not uploaded a presentation. You will get it in a minute or so. So please bear with them. So probably they will quickly see that they'll be able to address the concern. With respect to the discussions that we are having, a presentation in terms of how markets are evolving and how these systems are functioning in today's context. What you are seeing here is this cashless discussion that we are having gaining prominence. So keep an eye on those developments from various angles. So that would be interesting for your consumption too. So from a perspective of measuring money, what is important here is we have to pick and select out of what assets that we would take into consideration in terms of compiling monetary stocks. Okay, so constructing monetary aggregate is very important in today's concept, and the base and the basis for selecting what assets to be considered for the concept of money depends on so-called concept of liquidity. right? So liquidity we would come across in greater details as we move on, but it is the efficiency in which you can convert any assets into notes or coins, right? So that's the basic idea behind liquidity. So when you construct so-called monetary aggregates, you prioritize most liquid assets first, right? So in any environment, you would come across various financial assets, but some require time and some cost in converting into most liquid form of notes and coins. You may see you have fixed deposits with banks, right? You can get a currency withdrawn, but probably when you convert fixed deposits into most liquid form of assets, either you have to incur a cost, because what you simply see is fixed deposits have a fixed timelines. So if you move out from fixed and make it a demand deposit, that means you can withdraw at your wish, at your demand. So your interest rate payment structures applicable by the bank would be different. So you have to kind of incur a small cost there. Sometimes it would be significant. Similarly, there are other forms of assets, right? You might have commercial papers, certificates of deposits. You might also might have currencies of other jurisdictions, not global currencies like US dollar, euro, Japanese yen, sterling pound. I mean, the Chinese yuan. These are very, I mean, liquid currencies. Everybody would like to hold, but depends on the jurisdiction. Some currencies would not necessarily have that carry. So that also has some form of liquidity concerns. But your own domestic currency is always the most liquid. So in your wallets, if you have rupees, that would be the most liquid. So at any given point of time, you are compiling this monetary aggregates in the form of most liquid to lower form of liquidity consideration. So you first take whatever the stocks that you have in the form of currencies. So that is the basic idea of this money measurement considerations. So you define these money considerations in the form of M's. So that's why I said M1, 2, M5, and you probably see in between you have M2, M2B, M3, M4, different aggregates. So you simply see the M1 consists of most liquid ones, and then M2 on top of M1, you add slightly lower liquid forms, and M5 similarly would carry all the M's that you have computed before M5 plus the less liquid form available in the market to make the monetary aggregate. So it is not that whole difficult concept, very simple. You assemble all the assets in the priority of liquidity first. So you bring those stuff in, and if you look at most of the countries, monetary authorities compile this most liquid M1 by adding currencies. And in US, TCs, travelers checks are very common. You can actually do transactions with TCs, but in Sri Lanka now we don't use TCs. Nobody issues TCs now. We had previously, if you have traveled and you can check with your brothers, sisters, parents, Thomas Cook TCs are quite famous, but now you don't see those stuff available in Sri Lanka. But sometimes the name boards, hoardings are still appears in different places. If you walk down Chatham Street, Hospital Street, you still see a smaller name board still appear, right? So that's because most of the time the tourist, the financial market is close by, so the TC has been issued in those places and they exchange TCs for currencies, right? But now it's not, because Sri Lanka has stopped arrangements for TCs some time back. So then you see the currencies apart from TCs, demand deposits. That means the deposits that you can withdraw at will, right? So you have a deposit in your bank, you can withdraw, and the arrangements are such that now you can use ATMs outside banking hours to withdraw. And sometimes the banks do not facilitate you to come and withdraw below a certain value through counters. They encourage you to go to ATMs to reduce their workload, and also to some extent to make people acclimatize with digital banking structures. So this is very interesting. And then you see you also add checkable deposits. These are instruction-based deposits, not fixed deposits, right? But these are slightly less than currencies in the liquid formula that we were discussing. So you expand this M into M2 and so on. So you see M2, you add M1, all the things in M1, plus time deposits. It is fixed deposits. Time deposits is fixed deposits, because you would fix your investments to a time duration. So you pull out this duration means you basically have to discuss with your financial intermediary, and applicable rates would be sometimes different. So that's why I said you had to incur a cost. Okay, then you come into saving and other money market deposits account, mutual funds, where you pool your funds and invest. So when you wanted to liquidate them, either you carry a market risk in the form of interest rates changes. So all possible. So what you are basically doing is you are adding onto M1 with other forms of liquidity. So these forms that you are seeing in M2 are less liquid than what you see in M1. So everything that you define here, you are not seeing in Sri Lanka. So this is more or less the general arrangements that you are seeing in international financial markets, right? International monetary environment, but not necessarily in a specific country A, country B. But you generally see in advanced economies, they do. But in Sri Lanka's case, you can go to chapter 8 in the Central Bank Annual Report. You will see all these money measurements are there. And there are tables also in terms of aggregate numbers being looked at. So you can actually refer to some of these aggregate numbers. Please note down and visit the Central Bank website and check some of those chapters, where you will see what's the aggregates in terms of Sri Lanka's measurement of these different terms. That is very important, because most of the time the questions also try to kind of, talk about some of those inside those aggregates in Sri Lanka. So that's very straightforward and interesting how the different building blocks being brought into the equation, and they are showing you the different M's to the equation. And you are seeing here some representation. This is US numbers, US Federal Reserve, that's the central bank or the monetary authority. So you see M1s, that is nothing but the most liquid forms. And then you add all these M1s into M2 with more or less time deposits, money market and saving deposits account. See the numbers. Interestingly, that's very big, because most of the time people don't keep everything in liquid form, because if you keep in currency form, that currency do not work for you, do not earn for you. What is in your wallet would not bring you a return. Okay, what is in M2 often would bring you a return. So you don't keep all what you earn in your wallets, only a smaller percentage, right? So that is again reflective if you see the aggregate numbers here. And most of the time you see savings and money market deposits take a bigger share, and M2 is significantly higher than M1. But these structures under normal circumstances that you are seeing here would change under exceptional circumstances. If everybody started believing markets are in panic, markets are in difficulty, prices are the corner, so you will move your savings and money market deposits into more or less M1 form, right? This changes. So this changes with the economic circumstances that you are exposing yourself and you are encountering yourself. So you have to keep an eye. So these are also early indicators of economic difficulties. If you see the saving deposits are declining, term deposits are declining, you probably see people are a little hesitant, and they have not necessarily confident about financial intermediation given the circumstance. There are times where people try to pull out everything they deposited, right? So those are bank runs. We will come to those stuff as we move on. But what is interesting here is the concepts itself gives you idea into how markets take these aggregates, these numbers for your measurement of monetary aggregates, but at the same time as the directions of economic possibilities. We closely monitor as policymakers in terms of some of these developments on a regular basis. So that gives us a lot of information, right? So you see these possibilities, and see here you have pooling most of the M1s, and then you see M2 consists of M1 plus other liquid forms, less than M1 liquidity, and then you move on to, you see, M3, more or less other forms of M's in the case of this aggregate compilation. So don't confuse yourself, but make it very simple that you line up in the order of liquidity and consider highest liquid forms in the M1, and gradually kind of, you know, add on to this M1 in terms of building other M numbers that you will be using for different purposes. And this is not the same across all the countries, slightly deviate, but the meaning is you basically look at the liquidity. Okay. Any questions? Right. So you will see when you look at these M considerations, monetary aggregate considerations, which measure of money is considered depends on your economic circumstances, right? So very, very interestingly, these M numbers also move in different directions in the short run, but in the long run, generally, all the monetary aggregates take a one direction, often increase. So what you are basically seeing here is either M1 could increase faster, M2 can increase faster, or when M1 increases, M2 decreases. There are various reasons, right? And then the conclusion here is the choice of what monetary aggregate to be looked at is a decision of the policymakers, and often they look at high-powered money, base money, in other words. And this is the most liquid form of M's that we are talking here. Even within that M1, they would look at so-called high-powered money. Just keep it for the time being in your head. We will not require to know what is high-powered money for the time being. You will come across as we move on. But there are elements within this, right? So interestingly, you can figure it out, these numbers, as we move on, with some also questions to be asked in the form of, where are all the US dollars that's been put into circulation by the Federal Reserve. Are these US dollars all available in the US itself? No. You know, it's everywhere. All the countries are holding the US dollars and other high-powered, if not highly liquid, international currencies. Okay, so what matters there is, even though in US case, M1 could look very big in that sense, they require to have a segregation, what is onshore and what is offshore. Onshore is within the jurisdiction of US and offshore is outside US jurisdictions, right? So these are possibilities. These are possibilities that the US is looking at. And you probably see what is held within US sometimes is lower than what is held outside US, right? So where are all these US dollars? Who is holding them? Sometimes you find even criminals, and you probably see in the movies a stack of dollars being kind of, you know, exchange, and thrown out everywhere for various purposes. And then the foreigners, they hold for international transactions, and also for that matter, the foreign countries hold US dollars and US assets in the form of reserves, right? So they keep these stuff because that's the international liquidity. So they can convert international transactions being settled through holding of these reserves. And Sri Lanka too, currently having very challenging circumstances in maintaining a reasonable volume of foreign assets, simply because challenges in the form of inflows that used to have in Sri Lanka very frequently. For instance, tourism related inflows and things like that has basically paused. You don't see anything except very smaller numbers now being aggregated. But effectively, prior to 2019 April, we used to have annually about $4 billion of tourism-related inflows. That's not to be seen now, and it's quite challenging unless people adjust some of their pattern of living, because you still consume a lot of goods being produced outside Sri Lanka, and that's challenging because you have to pay. They don't accept you Sri Lankan rupees for that, right? So there are various elements behind this. So you see where all these US dollars. So interestingly, this is a challenging question everybody would look at, and also you probably see these developments would go on for a number of years, right? So any questions up to now? Right. So you are seeing this evolution of the form of payment system that we discussed, and recently you also see the concepts of bitcoins gaining prominence. Okay, so it's also a form of digital currency, and interestingly, other electronic form of the payment arrangements being controlled by mostly the central banks or the payment authorities in respective jurisdictions. But when it comes to bitcoins, this being created and held electronically, but no one controls it. And these bitcoins are also not printed like paper notes of dollars or euros for that matter. These are produced by people and increasingly businesses, and maintained in electronic form, in electronic software, and these being used for solving all kind of, you know, complex mathematic computations. But interestingly, bitcoins, most importantly, and that it makes different to conventional money is this is decentralized. This is not centralized, but decentralized. No single institution controls the Bitcoin network. This puts some people at ease because it means that large banks or large central banks or large countries cannot control their monetary stocks, because central banks and the governments could control monetary stock at different points of time due to its influence on economic activities. But when it comes to a arrangement like Bitcoin, that has much more flexibility, where it's not being kind of controlled by a single entity. But interestingly, because of this feature itself, there are certain type of risks and considerations now all the countries are looking at and try to address some of these stuff. And it is also at a stage of further improvements and evolution. So we cannot basically conclude that this would be the answer for the electronic payment structures that we are looking at the moment. It's evolving, and it's evolving very fast in recent years. But Bitcoin is one form of storing wealth, right? Using in the payment arrangements, that's as a medium of exchange. In today's context, mainly among established financial or business enterprises, if not high net worth individuals who has significant wealth and reasonable control over their assets in multinational corporations and in their financial markets. So this is something you can continue to read. So we would not conclude Bitcoin is currently expanding, yes, but would not be able to kind of conclude right now that would be one of the solution for paperless argument. But electronic form of payment structures would evolve, and as you have already seen. And then we are seeing some numbers, long duration behavior of M1 and M2 in US. You can see here, this is the growth or the change over the previous year. So what it says is, over a certain amount of volume, the following year, the stock or the aggregate of M1s have changed by X amount, aggregate of M2 has changed by Y amount, and you probably see here the changes are not necessarily in the same aggregate. So you can see here, at times of financial distress, if not financial stress in the markets, you find M1 aggregates grow faster. For instance, most recently 2008-9, and even since then, because financial markets had difficulties where the banks or the financial intermediaries had difficulties. So people preferred still maintaining sizable, highly liquid form of assets than maintaining in financial intermediaries. So probably the ownership or the maintenance of assets being shifted in favor of M1 in recent years. And also the central bank have injected big volume quantitative easing arrangements, QE programs all around the world to inject a lot of high-powered money. I said high-powered money, and you don't need to worry at the moment what is high-powered. Very simply, it is the currency in circulation plus reserves held by banks with the central bank, right? So high-powered money is nothing but currency in circulation plus reserves held by banks with the central bank. So for what, how, we will come to those discussions as we move on. But interestingly, those are driving. And even in late 80s, higher growth of M1 was noted because high inflation, Okay, so people started making use of the more less liquid form of assets maintained with financial intermediaries in the form of saving deposits converted into real assets, right? So they converted them into real assets, and here you see M2 is M1 is going negative at times, right? Because they have seen very low interest rates prevailing, and that's discouraged them to maintain them in a reasonable liquid form. They have gone into other form of assets. So that also driving. So different periods across a financial system, financial structure also guides these M aggregates to behave differently. So with that note, we will conclude this chapter, the discussion of this chapter. We will move into the next topic. I think you have the handouts available. That's a very interesting and very important topic. Before I move into that discussion, any questions? Right, you can even use the messaging if you have a question, if you are not having anything to raise at the moment. So you will look at the behavior of interest rates, which is very, very important topic from the perspective of this program. And I believe this topic we will continue in our next class discussions too. And what is interesting here is you have to accept the fact that the level or the height of interest rates do not remain the same all throughout. At different periods of interest rates that you will come across and discuss, the level or the height is again different. At different periods, you probably talk about double-digit numbers of interest rates. And then you will also discuss at different periods, no double-digit numbers, it's single-digit numbers. This is same for US, this is same for developed countries, and this is same for Sri Lanka too. And in Sri Lanka's case, you probably see now nobody talks about treasury bill interest rates of double-digit numbers. Treasury bill 1-year rate is around 5.2% in Sri Lanka now. Right? In late 2008-9 period, Sri Lanka's treasury bill interest rates almost at 20%. In 1980s, it is closer to 20%. At times, it's more than 20%. Right? There are reasons why interest rates behave like that. We'll be able to see such with the concept of Fisher equation and real interest rates as we move on and discuss. Okay, so in this discussion, you probably see in the US case too, nominal interest rates using the term nominal. That's very important because I said concept of real interest rates and Fisher equation. So we will come to those and detail in our discussions. Nominal interest rates are the ones that you are generally seeing that's been expressed and quoted in the market, unless somebody very specifically say this is a real interest rate, right? So everywhere, if anybody quotes, it's the nominal interest rate, right? So nominal interest rates of 3-month treasury bills in US around 1% in the early 1950s, but this has increased to 15% by early 1980s, even in the US case, then fell back to about 3% in early 90s, and then again increased, then again fell, and currently it's about only about 20 basis points. 20 basis points is 1/5 of a percentage point. 100 basis points for a 1 percentage point. So it is 20 basis points, means 1/5 of a 1 percentage point in today's context of a 3-month treasury bill rate in US. Okay, as I said, in Sri Lanka case too, interest rates behaved in a similar direction, similar fashions. Okay, and what these substantial fluctuation in interest rates explain to you. And one element of studying this program is to understand this question and to explain this question. Right? So you are learning few aspects here to see and review and analyze and explain why the interest rates behave like this. Okay, in this section, we examine how the overall level of nominal interest rates. As I said, unless otherwise somebody refers very specifically, interest rates mean nominal interest rates. Okay, and we examine how this interest rates is determined and what factors influence this behavior, their behavior. Okay, and we learned at previous points, actually from the very first lecture itself, interest rates and price are negatively related. What do you mean by negatively related? When prices increase, what it means with the other variable interest rate that we are talking here, when prices increase, interest rates decreases. You will get into greater details in next lecture if we start about interest rates with the bond market equilibrium and things like that. So the prices and interest rates behave in the opposite direction. That is the negative relationship. When the interest rate increase, what it effectively means is price decrease. When price increase, what it effectively means is interest rates decrease. So when you look at the interest rate, if you want a face value of 100 rupees after some time from your investment, you would like to invest at a price very much away from 100. If you want to get 100 at maturity, you would like to receive the price at the time of investments very much below the 100 levels. So then what happens is you get a higher interest rates. Lower the price, higher the interest rates. But if you invest closer to 100, that means the price is high, then the interest rate is low. That's what the negative relationship is all about. But then that is a discounted instrument. But there are financial assets like bonds, which is not only carries this price-based influence, but also there are coupon interest rates available. So how that link to the price, you would learn as we move on, most likely in next lecture. But interestingly, still the price and interest rate relationship is same. It is negative. Higher the price, lower the interest rates. Lower the price, higher the interest rates. So today, now onwards, when you walk for each step that you are taking, just tell yourself that higher the price, lower the interest rates. Lower the price, higher the interest rates. You will never forget this concept, right? So you will definitely keep that a little bit of exercise. You will keep that forever in your head, and the concept and the theoretical explanation is always same. No change irrespective of all the other developments, but looking at price and interest rates, the relationship is negative. Okay. So what you are basically seeing is bond prices change. By looking at price from this concept, you can also explain where the interest rates fluctuate. So by looking at interest rates, you can again correlate that to where the prices behave. Okay, to do this, we make use of supply and demand analysis for bond markets and money markets to see how we examine interest rates behave. That we will more or less start in this discussion itself. Okay, so to derive demand curve for assets like money or bonds, because money market instruments are mainly money, and then of course bonds, this is more or less the financial market, so the capital market instruments. We take first steps in our analysis. We first understand what determines the demand for assets. We look at demand for assets concept, and through which we will try to explain, try to understand what's driving the demand for financial assets. What's driving the demand for the shoes that you like to wear. Similarly, what drives the demand for financial assets? We look at those. Okay, and we will look at this demand for financial assets by examining the economic theory. This is called theory of asset demand. Okay, so this theory of asset demand that outlines the criteria that are important when deciding how much of an assets to buy. Okay, so with this theory in hand, we can then go on to derive the demand curve for bonds and money. But don't get too excited. This demand curve for bonds and money is very straightforward from what you have already learned in your basic economics. After deriving supply curves for these assets, you derive the demand curve, fine. So you also derive the supply curves that would help you to develop the concept of market equilibrium. That is the point at which the quantity supply equals the quantity demand. You know this better than me, I suppose, because you have learned these things. Okay, and this model that we are trying to build in terms of demand and supply to derive the market equilibrium would tell you the equilibrium interest rates and its changes. So same as the demand and supply curves you see for any goods in the market, and how you have derived the price for those goods in the market, and how those prices changes. So we interpret here the equilibrium in terms of interest rates. Okay, and also in this section we'll try to understand the interest rates on different securities tend to move together. Okay, they tend to move together. One type of interest rates increases, yes. Then another type of financial asset, financial securities also move. Okay, so we'll try to see in that context in this section as if there were only one type of security and a single interest rates in the entire economy for easy understanding. That is very easy, rather than bringing all type of interest rates into the equation and making our life complex. Because we know it's moving together. Interest rates, when financial assets interest rates changes, often one type of asset behavior would signal the other type of assets too. So because of that reason, we'll try to kind of keep ourselves simple by studying the single interest rates in the entire economy. And in the following section, right, we expand this analysis to other interest rates and the securities to understand why it's differ. That makes life much more easier. Now itself, don't confuse. Can try to kind of complex yourself by looking at all the interest rates, but we'll try to concentrate on a single interest rates in the economy and try to understand the elements here. Right. So as we said, first we wanted to know what determines the asset demand. You can be firm here to say financial asset demand. Financial assets. Demand for financial assets. What determines demand for financial assets? Okay. There are four major elements that determines the demand for financial assets. First and foremost, the wealth. This is not only the income or the remuneration you get. You already know the concept of wealth because we touched upon this when we were talking about financial systems, right? So the total resources owned by an individual, okay, including his, okay, inheritance. He inherited 5 acres of land, 21 buildings, 5 motor vehicles, right? Many plantations, many stocks from their parents, so on and so forth. You can build all those stuff into the wealth. Plus his earnings by working as a, let's say, a fashion designer or a chef. That's his passion. So he earns through that too. So his wealth includes everything that we discussed. So that determines his demand for financial assets. So everything included, that determines his demand for financial assets. Then the next aspect, that is expected return. The return expected over the next period on one asset related to the other assets in the financial markets. You have number of financial assets in financial market. You can pick one over the other. So when you see one financial assets return is significant compared to other financial assets, there's a possibility that you will pick the one with higher return. That is the rational expectation of any human being. Okay, so the expected return also a matter. So you look at the return probabilities, possibilities of one asset over other assets, alternative assets in the financial markets. Then also you look at risk. You already know from our discussions, higher the return, higher the risks. Lower the return, lower the risks. Like what I was mentioning to you a little while ago, higher the price, lower the interest rates. Lower the price, higher the interest rates. You also can use as a mantra, taking steps while kind of saying to yourself, higher the risk, higher the return, lower the risk, lower the return. So that is also a truth. And effectively, that's how financial assets behave. So the risk is nothing but the degree of uncertainty associated with the return, realizing return of one asset or the other assets. So you probably looked at in the previous point expected return. What is the expected return of a financial asset, one financial asset against the other assets? So you selected one asset which is very much gaining and giving you a higher return compared to others. But you also have to look at the risk. If that asset has a higher risk, of course, some would love risk lovers. They would love to take that risk and in exchange gain that higher expected return, but some would not. So the demand for financial assets not only rely on expected return. Yes, it's rely on expected return, but at the same time, demand for financial assets also relates with its associated risk. Then also you see the liquidity. Okay, so we discussed this liquidity and the understanding in terms of determinants of asset demand is that the liquidity has to be the ease and speed. It's no point, I mean, if you wanted to require the liquidity, you get your asset converted into most liquid form of coins and currencies 1 year from now. So by that time, what you wanted to buy from the market would not necessarily be in the same form or the same price. It also changes. So the speed and ease, without going through the hassle, without going through the cost elements, the liquidity is the ease and speed with which an asset can be turned into cash related to other assets. That's why sometimes the real estates would be a more or less reasonably secured investment, but unfortunately, converting them into cash at a faster pace is sometimes challenging. It depends on a number of other factors, right? So these are the elements which drive some people to accumulate assets in one form against the other forms of assets available in the market. So what matters here is theory of asset demand. What are the determinants of asset demand? The wealth, expected return, risk, and liquidity. So this is very, very important. Any questions? Right. Okay. So now we bring in the concept of holding all other factors constant. You know that. Ceteris paribus condition in economics. So the theory of portfolio choice that helps supplements the theory of asset demand by bringing in the consideration while holding all the other factors constant, because those factors change, this also change. To say that, the first point, the quantity demanded of an asset is positively related to wealth. So to say that higher the wealth, higher the demand for assets. Lower the wealth, lower demanded of an asset, quantity demanded, okay? So similarly, expected return. Quantity demanded of an asset is positively related to its expected return relative to other assets. You are comparing there, not in isolation. So you see, wealth is positively related, expected return is positively related. How about risk? We already know higher the risk, higher the return. Right? So it is positive. Higher the risk, higher the return. Risk and return is positively related. But demand of an asset relative to risk is negatively related. So what you are basically seeing is higher the risk, demand for that asset is lower compared to other assets, which may be lower in risk. So you know, wealth, expected return, positively related, but risk is negatively related. Then liquidity. Right? So when you see higher liquidity, that is ease and speed in which you can convert an asset into cash is greater. The liquidity is very high. That asset has a wider demand. So what you are seeing here is the wealth, expected return, and liquidity is positively related to asset demand, whereas risk is negatively related to an asset demand. So don't confuse, don't miss these points. This is very important. And we analyze this by keeping all the other concerns, other factors constant. The ceteris paribus condition. You see, we have then put all this into a chart here, into a table here, and you can just kind of, get the direction of the variable change and what would happen to content demanded of an asset. So we already know wealth, expected return, and liquidity is positively related to the quantity demanded, whereas risk is negatively related to the quantity demanded. Right. So you know now the theory of asset demand, also supplemented by theory of portfolio choice in terms of wealth, expected return, risk, and liquidity factors being concerned. So supply and demand in the bond market is what we are trying to now understand. The basic principle when it comes to the bond markets are at lower prices. That means higher interest rates. Other things constant again, because with the other consideration, even the prices are lower, right? Things would be different. But taking other things out and believing it's constant, the lower prices, that means higher interest rates, the quantity demanded of bonds are higher. What you are basically seeing is at lower prices, demand for bond is higher. What you are basically concluding here is an inverse, if not negative relationship. Lower the price, higher the demand for bonds. Lower the price means what you are seeing here is higher interest rates. So price is lower, you see the demand is higher. Then from supplier's perspective, lower prices, that means higher interest rates, other things being considered, the quantity supplied of bond is lower. It's a positive relationship. Lower prices, lower supply. Lower prices, higher demand. It's an inverse. But supply is positive. Why? At lower prices, demanders would have a higher return. At lower prices, suppliers would have a higher cost. So it is natural that suppliers would prefer cost to be reduced, right? So at lower prices, they would supply low. At lower prices, demanders are happy, they have a higher return, other things constant, right? Like risk, you are now not considering here. Then they demand more. So that basically the supply side and the demand side in the bond market. I said at the very first lecture itself, these things can be also put into mathematical equations and explained in terms of mathematical and econometrics jargon, but we don't need to, because for this program, you don't need to get into those. And I said we will not be using those, but conceptually, this is the principle, this is the outcome. So for anybody who wants to go through those exercises and learn more, go deep into those concepts, you are very much welcome to take further courses and even doing graduate level studies, postgraduate level studies. That would help you to kind of, get into that, but you will land ultimately to come to this conclusion. Right. Any questions?
Sir, can you explain one more time the interest and prices, the relationship again?
Right. So the interest rates and the prices relationship. So when you see price, when the prices are higher, you are basically seeing a circumstance where you are quite closer to a face value of a financial asset. Face value is what's the printed value or the obligation on the part of the issuer or the borrower. So if it is 100, if it is closer to 100, let's say 98, the difference is 2 rupees. So if you look at 98, the value that you are investing, for 100 rupee that you will get at 1 year maturity, your interest return is slightly more than 2% for 1 year. So the price at 98, face value at 100, your 1 year return is quite, small in this context. It's about 2%, slightly more than 2%. But you look at the same 1 year asset, face value is 100, but you are investing at 90. Earlier 98, 1 year return is slightly more than 2%. Now it's 90, you will get at the maturity 100 after 1 year. So the price difference is 10 rupees there. So your return for that investment is slightly more than 10%. Not 10% because you are investing in the first place at a discounted price. So there is more than 10% because your 90 investment yielding 100. Earlier it was 98. So what you are basically seeing is higher the price, 98 the price, and you are comparing 90 the price, higher the price 98, interest rate is lower. Compared to 98, 90 is lower. That means lower the price, interest rate is more than 10% now, is greater than more than 2% at 98. So you are basically seeing here is higher the price, lower the interest rate, lower the price, higher the interest rates. Any financial asset, that relationship is unique. That's not going to change. If the price is lower, interest rate is higher. Price is higher, interest rate is lower. And you can again nicely take that consideration in this the chart here, the demand and supply for bonds table here. We'll be able to explain the same and you'll be able to understand. So you see here, as I was mentioning in some of our discussions previously, in Sri Lanka, the face value of a bond is 100. In US, face value of a bond is $1,000. That means the price of a 1 unit of bond in US is 1,000. Right? So at 1,000, assuming there is no coupon payments, interest rate here you see the y-axis, it is price. X-axis here is billions of dollars quantity. At 1,000, if anybody invests there is no return because end of the day, after holding it until maturity, you are gaining 1,000. So today you are investing 1,000. You are at maturity also getting 1,000. That means no return. So you are basically investing at I, that is interest rate, at 0%. Right? So the point here is there is no return if you invest at face value itself. Here this bond doesn't have any coupons. When it comes to coupons, if you invest at 1,000, still you get the coupon separately. So you have a return. This is so-called zero coupon bonds here. There is no coupon explained here. Zero coupon bonds here. So price, and at that price itself, if you invest, you don't have a return. But prices are now declining. So ultimately, this would be zero here. This is y-axis. So prices declining from 1,000, 950, $50 of return after keeping for the duration. So annually, if this is an annual investment, you see return is slightly more than 5%. I said this is then discounted investment. Face value is 1,000. So you are basically investing 950. So getting 1,000 at maturity. So your return per year is 5.3. If you calculate it, is 5.3. Yes. When it goes to 900, see the price is even lower than 950. Interest rate is more than 10, it is 11.1. And similarly, price is 850, 800, 750. See, higher the price, lower the interest rates. Lower the price, higher the interest rates. So if you are drawing this graph in the y-axis, interest rates here, so lower interest rates would be here, higher interest rates would come to top. But you are drawing this graph in the form of a price in the x-axis. So higher interest rates means lower price. Lower interest rate means higher price. So at higher prices, you have lower interest rate. So it is natural. So you invest 1,000 and you are getting 1,000 at maturity. That means you don't have any interest return. So invest 750, you get 1,000 at maturity. You have a more interest rate gain. So as the prices decline, interest rate increases. So I believe it's clear now. And you see now the bond demand and bond supply being analyzed. You already know the demanders would demand more bonds at lower prices. That means higher interest rates. So you draw a point here. Here, this point E of bond demand curve. At lower prices, 33% higher interest rate, they want quantity E, let's say 500 according to this chart here. Then the prices increase, that means interest rate decrease. Still they demand, but not to the level of at price 750. Slightly higher price, quantity demand that has come down to 400. Similarly, at 850, 900, 950, prices are increasing, interest rates are decreasing. The quantity demanded also decreases. Demanders demand less when the prices are high, interest rate is low. They want higher interest rate. That means they want to buy at lower price, that is here, and gradually with prices are increasing, interest rates are decreasing, they are reducing the demand for bonds. At zero interest rate, nobody demands anything. That is the demand curve. And if you now join the dots that we have created and draw the line, you see it is a downward sloping yield curve. Downward sloping line, not yield curve, okay? It's a downward sloping line. Higher the price, lower demand by demanders because interest rates are lower. At lower prices, higher demand by demanders at higher interest rates. So you join these points, you can draw a bond demand curve. This is same as you go to the Sunday market and buy apples, orange, whatever vegetables you call it, other things being constant. At higher prices, you will buy less mangoes. At lower prices, you opt to buy more mangoes. You will like similarly for oranges, apples, vegetables, anything that you have in the market. And if you put the aggregate, everybody else in the market is concerned, at lower prices, more goods being purchased or demanded compared to higher prices. So it's very natural. Demand curve is downward sloping. At lower prices, more goods being demanded. At lower prices, more bonds being demanded. At high prices, less goods being demanded. At high prices, less bonds being demanded. So that's what you are seeing here. That is the demanders behavior. the bond demand. So now look at bond supply. Bond demanders, what they are looking at? The return. Higher the return, they are get attracted. Bond suppliers, what they are looking at? The cost of financing, cost of borrowing. So when the prices are low, let's say 750, interest rate is 33%. Their cost of borrowing or cost of financing is 33%. So they prefer to supply less because it's costly. So as the cost reduces, that means price increases, the suppliers become motivated. I mean, same in the goods market. When the mango prices are higher, more people will grow mango and more people will bring mango to the market. When mango prices are low, suppliers get discouraged because they have a less profit. So they bring less mangoes to the market. Similarly, the bond suppliers at lower prices, they had to pay higher cost for borrowing. So they supply less. At higher prices, as you move on 750 to 800, 850, 900, 950, they supply more because their cost of financing is reduces. So you join these points, what you are seeing here is supply curve for bonds is upward sloping. Higher the prices, more supply of bonds because interest rate is lower. At low prices, less supply of bonds because interest rate is greater or higher. That is the supply side. The demand side, at high prices, the return of investment is lower, so less demand by demanders. At low prices, interest rate is greater, interest rate is higher, so the return is high, more bond demanders demand bonds. So that is the bond demand curve. So you see bond demand curve is downward sloping, bond supply curve is upward sloping. And these two curves intersects at one point. That is nothing but the equilibrium that you are familiar with any other type of market that you have learned with. So the bond demanders and bond suppliers meet at the equilibrium point. That is, in this case, is price at 850 and the quantity at 300. So price at 850, the interest rate is 17.6. So the market equilibrium is point C, where both supply side, suppliers, and demand side, demanders, curves are intersecting each other. So the any point above C, where the supply is greater than demand, because suppliers supply more because interest rates are lower, but demanders demand less because interest rates are lower. Suppliers get motivated by low interest rates. Demanders get demotivated by lower interest rate. What you are seeing is any point above C, the excess supply prevails in the market. Similarly, at points below C, right, suppliers get demotivated simply because interest cost is higher, but demanders get motivated because interest return is higher. You see excess demand. So here it is excess demand. Here it is excess supply. So the same concepts that you learn all throughout your demand and supply from economics. So same thing being applied here by looking at the price and quantity relationship, very much same as your general economic considerations. So the difference in terms of price axis here is that you explain prices and you link that with interest rates. So higher the prices, lower interest rates, lower the prices, higher interest rates. So you can easily again kind of, fix this in terms of the interest rate consideration itself. So that's mainly the demand and supply curve for bonds and market equilibrium, right? So what you are basically seeing here is the equilibrium happens in the market, okay, when the amount that people are willing to buy, that is the demand, equals the amount that people are willing to sell, that's the supply at a given price. So the bond demand and bond supply defines the equilibrium. Bond demand equals bond supply is the equilibrium or the market clearing price, and effectively the market clearing interest rate, because bond suppliers and bond demanders are keen on interest rate, and with that you can also figure out the quantity demanded, quantity supply. When bond demand is greater than bond supply, you already know there is excess demand. Bond demand is greater than bond supply, excess demand here. At this point, supply is lower, demand is higher. Here, excess demand. So as a result, you have to get suppliers to supply more, demanders to kind of, demand less in terms of interest rates. So as the interest rates decline, some demanders, they previously wanted to buy bonds, would go out. They don't like that interest rate. So the demand get less. As the interest rate reduces, suppliers previously don't want to supply because interest rates were high, now ready to supply. That's why the supply side increases, demand side decreases, and ultimately reach the equilibrium, where bond demand is greater than bond supply. When bond demand is greater than bond supply, there is excess demand, price will rise, interest rates will fall. Similarly, when bond demand is less than bond supply, there you get excess supply in the market. So price will fall, that to increase the interest rates, to motivate demanders to demand more. That's what you are seeing here in this section. The supply is greater, demand is less. Okay, so suppliers are happy, interest rate is lower because prices are high. So they are ready to raise more money. But demanders, no. Only few people are here ready to buy at this interest rate. So you have to give more interest rate. So that means you have to reduce the prices. So you see the along demand curve, the prices are declining, interest rates are increasing. And suppliers, some move out. That cost is too much for them. So they reduce the supply. So ultimately they reach the equilibrium here. So this is the market clearing point. And this market clearing point changes with shifts in theory of asset demand. So that's a point we can start discussing, because that would be ideal for us to take up the concepts and elaborate further. Any questions of what we discussed today, what we discussed up to now? And there are some questions. One is to say, market including banking sector could maintain at equilibrium. Equilibrium for me is different to equilibrium for you. Equilibrium for party A is different to equilibrium for party B. So general market equilibrium is everybody's aggregate. So for instance, even inflation, CCPI, Colombo Consumer Price Index, it is the average of basket of consumptions. My consumption is different to your consumption. Somebody else's consumption is different to another person's. But if you just aggregate it, you might find a circumstance, majority of the items in the basket are not something I consume, right? Or for that matter, somebody else consume. But we look at it from the perspective of aggregate. So the aggregate defines where the market general circumstances. So the equilibrium will define in the bond market, okay, an equilibrium, that is the price at which majority of the people ready to buy, ready to sell. But there are people, they buy, sell away from liquidity. But because of this away from liquidity exists, market would try to see more supply, more demand come and play a role. It's like when the market is having a higher price, that get motivated to produce more apples or more mangoes. So more mangoes coming to the market means supply is higher. So because of that reason, price would reduce because supply is higher now, right? So then only they can sell because demanders think, oh, supply is high, why should I buy at a higher price? So he prefers to pay low, so the market adjusts. So similarly, the financial markets also, there's a concept called arbitrage. When the arbitrage exists, the market participants come and clear that arbitrage. So the market falls back to equilibrium. So it is very common. The drivers of this market possibilities is inflation, deflation, all possible. Recession is lower growth, negative growth recession. So this drives people's preference to buy. That means the wealth reduces. When you see your economy is on a recession, that means your economy is now smaller in aggregate value in comparison to what it was last year. So your wealth is now lower. What happens? Wealth is positively related to the demand for financial assets. So lower wealth means lower demand, positive relationship. Higher wealth is higher demand. So wealth has come down, recession. Inflation is that drives the expected interest rates. So if you are expecting higher inflation, you expect higher expected return. So if the asset is not going to give you a higher expected return, you naturally reduce your demand for assets. So I believe that clarifies that question. But generally, markets perform at equilibrium. Any points away the equilibrium would invite demanders and suppliers to behave differently and bring back the equilibrium to the market. So we will get into so-called arbitrage as we move on. Any further questions? We will learn money market equilibrium in the next class because this is bond market. So we will expand it to money market where the supply curve would be differently shaped. So that's the only difference. So we will learn that also. So if there are no further questions, we can stop at this point and we will have the discussion continuing at the next discussion. Thank you and stay safe.